So our discussion this week is about financial market crises, and we talked about commercial bank failures in great detail. We talked about the Bernie Madoff, which was, in my opinion, one of the historic cases of regulator failure, and it's not really a banking crisis per se, but it is a systemic risk to the mutual fund, hedge fund, and portfolio management industry. Um, and today I was going to actually talk about the AIG, but then I've noticed we already spent some time talking about what happened in the 2007, 2008, and all the way to 2010 financial crisis. We spent some time last week talking about the variable rate mortgages and mortgage-backed securities and how financial institutions have failed. And AIG was one of the guarantors or guaranteeing insurance companies, and which kind of exacerbated the entire financial collapse. But so perhaps continuing with that, I didn't want to spend more time on you know um, you know for instance Silicon Valley Bank or First Republic, which we already spent some time talking about it in class. And so I wanted to perhaps talk about this Gamestop and AMC Reddit issue. I realize it's not really banking per se, but our class is about institutions, and one of the institutions that we perhaps did not spend enough time talking about yet is the SEC. And the equity markets are vast, and there are thousands, tens of thousands of stocks, mutual funds, ETFs, and SEC's job is quite challenging given the limited budget that they have. So I wanted to spend some time talking about the GameStop, what happened to it, and how the stock price did this, and see if we can actually come up with some sort of an understanding of how such a bad volatility, such a bad um, I'm not sure if we would call this manipulation, but such a bad stock pricing behavior can happen. And if there's any legal issues or legalities of it, or if there are any ethical concerns, perhaps we should talk about. So before that, though, I want to talk about a few things. Set the terminology domain straight, and then we talk about what happened specifically to the GameStop. So the first things first, I want to talk about what's a short sale, and then what is a margin, and then we go from the short sale and then the margin to talking about what's called a short squeeze, because I think that's primarily what happened in the GameStop case. So, what is a short sale? So let's look at the CNBC. Let's say that I actually think we're just assuming, and we're talking about lecture purposes only. Let's say that I have an expectation that the financial markets are going to be continuing to decline. And I'm looking at Apple, and at one point it was about, I think, a little over $190, and now it's at 166, and that's a huge drop. So let's say, for example's sake, that I believe it's going to continue going down. I may not, but let's just say that's what I think. So what I will do to do a short stay is that I'm going to borrow 100 shares of Apple. So, and I'll do this through my brokerage company. When you do a short sale, the brokerage company will automatically go through that borrowing the shares phase. And I'm going to do this today. And then immediately after I borrow these shares, I will actually sell these borrowed Apple shares. And I'm going to sell them at 166.89. So my expectation is that, say, in about a month or so, the Apple shares will be even lower. So I'm hoping to buy back the, you know, Apple shares. Let's say that at 150, and that's my hope, right? Um, and what I will then do is to return the borrowed shares. It's a very simple process, right? So, buy low, sell high. I'm just doing this in a different order, in which I'm first selling the shares that I do not have, and I'm simply borrowing them, and then I'm selling them at short. And that's the terminology comes from. Basically, I'm selling the shares that I do not have, and my expectation is as the Apple goes down, I will be able to replace these shares at a lower cost, and therefore I will sell at 166. I will buy them back at 150, which will make me a profit of uh, $16.89 per share. And since I borrowed 100 shares, this will give me this time 100, and that's about $1,689, which is a good deal if you think about it. I didn't even have the shares to begin with, right? So I was actually just borrowing somebody else's shares. So this is what we call a short sale. So why is this risky? Well, the problem now is that the 1689 was basically the difference between what I sold and the price that I actually bought. What if the market returns and Apple goes back to where it came from, and let's say that 190, and notice that now I have about a $2,311 loss. In fact, let's assume that it actually went above and beyond and say it's at 250. And notice now I actually have a significant loss. So the problem with a short is that the stock price can actually go down as much as the price. So the maximum that I can make on this is at $16,689. That is Apple applying for bankruptcy and stock price going down to zero. However, because I'm short, I have to buy these stocks back. And the problem with that is, what if the stock price goes to say $500 and or $1,000? I know I'm exaggerating, but I want to show you that there is no upside limit to your loss. Meaning, sky's the limit. And whatever the stock price goes to, you still have to buy back the 100 shares that you borrowed and replace them, and that's what you borrowed. You didn't borrow $166.89. You didn't borrow a $16,000 worth of anything. You just borrowed 100 shares. The person who lent you these shares don't care what the price is. They want their shares back, which means that once you sell those shares at the price, now it is your responsibility to buy them back at whatever price and return them within a reasonable period of time. So the idea then is, you have a significant. So now, from a brokerage company perspective, the idea now is that because you have this risk, they want to make sure that you are accountable, meaning that you're good for it, right? So if the price goes to 190, that you should actually have $2,311 in your account. But a lot of the brokerage companies will allow you to have what they call cash and in a margin account, right? So let's say that in order for you to be able to get into this deal, they will require you to have, I don't know, say $2,000. And from their perspective, they have two very good collateral. Number one, they have the money that you will get when you sell the shares, right? So from a brokerage company perspective, when you sell these shares at 166.89, the $16,689 will stay in your account as cash, and you won't be able to withdraw that money. And on top of that, the brokerage company will require to put down a margin. And I just made up to $2,000. It could depend on your relationship with the brokerage company, but it usually is a significant amount compared to what you are actually borrowing. So it could be as high as the whole amount, the 16,000, or say 8,000. Usually 1 to 2 is very common. So let's say that we have to go with $2,000. So now the problem now is that when you have this short and the stock price starts to go up, like right now it's 166, let's say that it went up to 170. So the brokerage company will probably call you and say, look, now you're at a loss and you have a bare minimum margin of $2,000 and you're already at a $300 loss. We would appreciate if you could increase the cash in your account, which is called a margin call. So they will probably ask you to put another $300 as at the end of the day, what they would refer to as they will mark to the market. So the idea is for you to keep that $2,000 cash in your account, and you have to come up with that $311 in extra just to make sure that you are not in violation of the margin call. So let's say that the next day the stock price continued going up, say 175, and now you have an $811 of a loss. And this time you will get another call that says that, look, you have a bare minimum of 2,000 and you have a $300 from the other day, but today the stock continued to go up. So we need you to put down another $500 to make it into an $811, $2,000 bare minimum. So as the stock price keeps going up, you're actually going to have a margin call. And that's the idea of the margin call. So we borrowed 100 shares at $166.89. We sold them short. And our intention is to buy them back in about a month or whatever your time investment horizon is. And then return what we borrowed. In the meantime, we actually are required to put down a margin, X amount of dollars in cash. And then as the stock price goes up, because we are at a naked short sale, our brokerage company will require us to have excessive or margin in excess of their bare minimum. And that in excess can be actually anything that your brokerage company may impose on you. In fact, in certain cases, they might actually require you to put more than your potential increase. So, for instance, the next day the price goes to 180, and you're thinking that you have to, put down $1,300 on top of the $2,000 bare minimum margin. You might actually get a call and saying that your cash margin is now, say $4,000, significantly more than you thought. So, and brokerage companies, they don't like taking risks, and if there is a certain volatility in the market with a certain stock, they will simply make sure that their risk is covered. So notice we're doing this at the end of every day, marking to the market. Now, the problem with that is, notice how for the Gamestop, the stock price actually in one day, look at that candle, actually jumped so bad that at one point the stock price was during the day. And by the way, GameStop had a 4-to-1 stock split, meaning that whatever price you see here used to be 4 times that. They just split it, right? But regardless, let's go with the current prices that are adjusted for that split. So the stock price goes from, say, $5 all the way to 120 in the case of just a couple of days. So what happens then is, if you are actually short the GameStop stock, your brokerage company may actually call you during the day with a very short time frame for you to increase your margin, which during the day you may not be able to increase it. You may not be accessible. And your brokerage company now has the right to close your position. Um, and it may be at your loss significantly. And so that's a problem. So the way it works during the day, when the stock price actually increases as such, but notice these um, candles. I mean, they're huge. So what happened was that a group of people at Reddit noticed that there are a lot of people who are short um, GameStop, GME. And when you're short, you're now susceptible to market price increases. Okay, now this is important. As the price increases, because your margin may not be sufficient, your brokerage company may actually close these positions on your behalf, or they might require you to have a profit loss order in place that would kick in as the price increases. However, the profit loss orders are not perfect. I'll give you an example. Let's say that you actually shorted the stock at 166, and your idea is that you actually have a stop loss at, say, 108, right? But if the day starts at an X number of dollars, well, let's look at Apple. Let's say that the day started out at a certain level, and let's take a look at it. So let's say the day started out at a certain level, and all of a sudden, like this, price started to actually increase or decrease. And notice how the price actually jumped right here during the day. Now, this is a problem because the stop loss order simply is a buy order that becomes a market order when the price goes above your trigger level. So it simply will become a market order once the price is above your trigger stop loss level, which means if you're short at 166 and your stop loss is at 180 and the price actually jumps, say from 166 to 190, then you have a market order to buy immediately at whatever the price. So you might actually um, end up buying it at 190, 200, 210, 300, 400. I mean, there really is nowhere knowing at what price your market order will be filled. It is just that your market order will become active as soon as the price goes above that limit that you set as your stop loss. So knowing this, brokerage companies have to maintain that you have to have at least a stop loss. However, they might actually proactively close your positions for you. Now, if your losses become so big that the brokerage company will start acting on your behalf and starts buying your short positions, that's usually referred to as a short squeeze. Now, the problem with a short squeeze is obvious that you can see, but let's spell it out. The idea is that you thought the price was going to go down. And people like you also thought that the stock was going down. Right? So this is a CNN Money piece on GameStop. And it basically explains how much of a short um, was in place right before the Reddit piece. And in a lot of cases, you can actually see. In fact, let's take a look. So let's take a look at let's close this, and then let's go to Yahoo Finance, and then let's look at a stock that's actually very popular with the short sellers, Tesla, and let's see how much short sellers there are in Tesla as of today. So that's supposed to be statistics right here. and then it's it. Right there. So it's a short ratio of, about less than 1%, right? Or the short percentage of float is about uh, 3%. Short percentage of shares outstanding, 2.66%. It's very low. And even for Tesla, 3% of the stocks are actually short sold. So at one point in time with the GameStop, the number was quite significant, which made the actual, um, I don't want to call them the manipulators in any way, but, um, speculators, let's refer to them as speculators, which made speculators quite eager to make a move on. And obviously when the stock is really, it has a lot of short sale, when the price starts to increase, and then the brokerage company starts to do automatic position closures, the effect of this is actually closing the short position and buying them back, which means that every closed short position not only removes the downside pressure on the stock, but it also increases a buy pressure or an upside pressure on the stock. So the more short closures you have, the more short squeeze you are going to have, and therefore you will have more of a bullish pressure on the stock price. So this is what happened with the GameStop. When the Reddit actually reported that they're going to start to make a move on this, and that the percentage of shorts were going to be squeezed up, the following few days, quite a few people followed their advice, and the stock price before split went from $20 or so up to $400, almost $387. And what I'm doing now is that I actually provide you with a ton of articles for you to read. Obviously, you don't have to read all of them, but each article has different um, information, and I'm actually providing you with a timeline. And I find this to be incredibly useful. Um, so, the idea behind this, um, the short squeeze, there's nothing illegal about it. You basically just buying it, and then you're telling your friends that you're buying this, and then you're telling your colleagues that you're buying this. And if they follow your advice, or if they just follow you, in finance, we refer to this as a herding effect. And as far as I know, there really is no legality behind it. I mean, it's not like I'm telling you to buy it. I'm just telling you that I'm buying it, and you follow what I do, or people follow each other, and all of a sudden that you actually have a herding effect, and because of that, now the price starts going up, and because the price starts going up, you have a lot of shorts who actually get squeezed up, and all of a sudden you actually start to have these jumps in the price, and as you have these jumps, more people say that the price is going up, and then you have a catch 22. Because I thought it was going up, and because people followed me, and because people got short squeezed, and it turns out I appear to be right. And because I appear to be right, now more people are following me. And the more people follow me, the more people buy it. And all of a sudden, you actually have a stock price that goes from $20 to $400. Now, here's the kick. Would you see, like in matter of case, we talked about how SEC, um, perhaps should have done more scrutinizing with the fund, although there's always that question of whether the SEC preemptively can do it or not. And also in the banking, we have the Fed and then especially the FDIC preemptively on a daily basis doing these checks. But in the financial markets for the stocks, an activity like this, I don't know if it is in the purview of anybody to simply regulate significant price jumps. And I'm not even sure if that's okay. You see, if we get a new information that Apple came up with a new technology, beam me up, Scotty, beaming technology, or a new car, electric car, or I don't know, something significant. And stock goes from $170 to say $500. What is it to anybody? If I'm willing to pay $500 for a stock, and I think that it's worth it, and the stock used to be at 166 just a few hours ago. Again, what is it to anybody? So, the idea now is obviously whether this was a stock manipulation, um, which I think is a little bit different than, um, stock price, um, simply going up based on information. So, um, I think that's what caused uh, all this discussion in the financial markets as to whether the GameStop was such a big deal. And in fact, right here I saw a paragraph about Robinhood. Um, so, as a brokerage company, one of the things that Robinhood did was they actually, at one point, they actually did not allow people to trade GameStop. Did not allow people to short it, did not allow people to buy it. If you had a position, they allow you to close it, but they did not allow you to open a new position with games. And again, I think it has to do with, brokerage companies want to protect themselves. And, at any point in time when a stock price goes from $20 to 400, as a brokerage company, I can see the wisdom in just, closing all orders. And I think it is within their right to do that. I'm not sure if there was any significant issue. However, that's what happened. So for the following days and months, and even today, the GameStop did not go back to where it came from. So there's still, the price became sticky. The company didn't have any material change. Brick and mortar company that sells games and exchanges them, and I don't know much about them, but I don't think the people who trade GameStop did either. But the price got stuck. So, from my perspective, I don't see much issue with legalities of it. And I'm sure that there's significant investigation by the SEC. And as you can see, the most that SEC can do is, post action investigation to see if anybody was at fault. And I think that's the difference between Fed, FDIC, and the SEC. Fed and FDIC can be preemptive in their regulation, and they can be concurrent with their audit. But on the other hand, with the SEC, it's usually after the fact. So, is it illegal to literally trade a stock during the days of high volatility? And you know, I was teaching during this time, and we looked at these option prices to see if we could actually trade this and perhaps make money with it. But the option prices were all over the place, and at one point, they actually stopped options. So entire trading of options became impossible. Um, and the price actually recovered just a little bit. You see, from $400 all the way down to 40, and that's another crash. It's all within the course of, say, 2 weeks, and then went back up to 320. I mean, it was just unbelievable volatility. So, is this legal, and is this ethical, and how is this possible? Three different questions. I'm not even sure if there's any sort of question about ethics, simply because nobody's actually forcing anybody to trade anything. And from what I've read, there wasn't any suggestion for people to trade on this, to buy this or to short this. Again, I think the people were very careful with their language as to not get in trouble with the SEC, and people were simply just saying, I'm buying it, I'm selling it, I'm doing this, I'm doing that. Whether you choose to follow them or not is your prerogative. Um, from the legality point of view, I think there's a lot more discussion about whether the brokerage companies should be blamed for this. Why wasn't a circuit breaker triggered during this activity at the exchange? Circuit trigger, by the way, is when a index, for instance, or certain stocks reach to a significant increase or significant decrease. There are different circuit breakers in different markets, but it usually stops trading for, say, 10 minutes. And then it happens again, it stops it for half an hour. And it happens again, it stops it for the rest of the day, things like that. So it basically, it just calms people down while, during the wild volatility in the market. So why didn't the circuit breakers trigger the GameStop trading? And if they did, why wasn't they, or why weren't they more permanent um, triggers? And why wasn't the SEC more visible every day and asking questions about what's happening? But then again, it's a question of whether is it illegal, is it, and I'm not even sure. Is there anything to do with that? The second stock that we actually had with a similar situation was AMC. And notice that they actually went from, say, $6 all the way to $375 in a matter of a few months. And in fact, from 74 to 375 in a matter of, say, 4 days. Very similarly to the GameStop, this stock actually this was so volatile. And notice now the current price is $9. Now, this was a stock that in this past June of 2021, the price was about 375 plus dollars, and now it's $9. So, you know, how is this even possible? Is this, how do you regulate this? So the question always is, if you look at the systemic risks that these individual cases expose other stocks, other systems, other financial institutions, if you will. With the banking, I think a lot of things are a lot safer, and yet we still have hundreds of banks who actually go under every year. And but the Fed and the FDIC are quite preemptive and proactive, and they preemptively regulate, audit, and intervene on a daily basis and take over banks on a daily basis so that the system is not shocked and that there is no contagion. In the case of mutual funds, hedge funds, portfolio management, wealth management, I think within the purview of SEC, now you have that huge dilemma of the post-action and pre-action regulation. And in the case of stocks, well, this is as free of a market as it's going to get, and therefore, do we actually have, or do we really want to have such scrutinized regulation when it comes to, stock prices? Um, there's always this freedom of speech that's being discussed as if I say I'm buying it, then I'm not sure if, I'm simply saying I'm buying it. It's not like I'm saying you should buy it, right? So in fact, I think Elon Musk actually said something about this. Yeah, so definitely, yeah, because I remember this. We actually had our student managed investment fund at this time when we were thinking like, should we actually trade this? And I think at one point, do we have the tweet? Um, yeah, so at one point, Tesla CEO Elon Musk actually got involved in this, and I think that made the increase a lot more popular. And when people start seeing these stock prices going up this much, they want to, they want a piece of the action. So, is this ethical to become part of this exacerbated um, deal, or the market action? That I don't know. But on the other hand, how much to regulate this is also, I think, a question to discuss. But think about it like this: from a regulator point, what do you think? Like, do you think that the regulator should be visible at all times when, during the day, when the markets are trading, and intervene very much like a central bank when a, individual stock has a jump price like this? Should we have circuit breakers for even, uh, you know, 10, 15, 20% increases? I'm not even talking about, tenfold, like 1,000% increase. Um, so where do we draw the line between um, overly protective regulator versus free markets? On the other hand, a lot of people got burned. I mean, you see how $375 stock is now not. So, perhaps we go back to the discussion of while we protect the deposit holders with Fed and FDIC, why are we as protective of investors? And again, perhaps it's because the stocks have an inherent risk, and if people are willing to take such risk, the regulator says it's not within our purview. So, having said that, I prepared a bunch of articles for you to read, and like I said, you don't have to read them all. However, I do find them to be quite interesting timeline of events. And I think the main question that we get out of this week's discussion is, how much to regulate, when to regulate, whose responsibility is to regulate, and should we actually have investors, depositors, and participants of the markets, the traders, or should we expect them to self-regulate? And so if you have any questions, please let me know. And thanks for working with me. And I hope to see you all soon. And thank you. Bye now.